Ever wondered how companies or even entire countries tackle that constant need for ready cash? That's a huge challenge, right?
Absolutely. Liquidity is often the name of the game.
And financial innovation often steps in with solutions. Today, we're doing a deep dive into a really big one, debt securitization.
Ah, yes. A powerful tool.
Yeah, think of it as a way to turn assets you can't easily sell into cash you can use right away. It provides that crucial liquidity.
That's a good way to put it.
So our mission today is to unpack what it is, how it actually works, and crucially explore the really big differences between the traditional view and Islamic finance principles.
And those differences are fundamental.
We'll also connect it to the global financial crisis, some hard lessons learned there. We want to pull out the key insights for you so you're properly informed.
So what is it at its core? Securitization, I mean. It's fascinating, really. It's about taking things that aren't easy to sell, like a big pile of loans.
Right, like mortgages or something.
Exactly. Mortgages, car loans, things like that. You bundle them up, and then you slice that bundle into new pieces, new securities that you can sell to investors.
Okay, so you're making the illiquid liquid. But this idea itself isn't brand new, is it? I read it popped up way back during the Great Depression.
That's right. Surprisingly early, around 1929, 1930. Countries like Britain and France, well, they started accepting things other than just cash to settle debts.
Like what kinds of things?
Raw materials, company shares, bonds. Basically assets they could hold or trade instead of just waiting for currency payments that might not come.
Interesting. And it continued after World War II as well?
It did, yeah. It evolved. The victorious nations had to deal with the debts of the defeated ones, and again, they often took shares, bonds, even real estate as part of the settlement.
So settling big national debts.
And then that idea kind of trickled down. It adapted to the corporate world, too. Imagine a company owed money. Instead of demanding cash, the creditor might take shares in the debtor company.
Okay, so it's about transforming that obligation into something else, something tradable.
Exactly. The core concept has been around a while.
But it didn't really become this huge financial force until much later, right? The 80s.
Oh, absolutely. The 1980s were the explosion point, especially in the US and Europe. They even called it the Securitization 80s.
Wow. Was it really that big?
Huge. Just look at Europe. That market was growing by something like $200 billion a year. It was massive.
And what were they securitizing back then? Still mainly big debts?
Initially, say from the 70s into the early 90s, it was pretty focused. Mortgages were the classic example, then car loans, credit card debt. But it didn't take long to expand.
To what?
Pretty much any predictable cash flow eventually. If you could model it, you could potentially securitize it.
And this wasn't just a Western thing. It caught on elsewhere, too.
Definitely. It gained a lot of traction in Arab markets, for instance, seen as a key part of financial reform, a modern tool.
Right. I think I saw examples from Syria and Egypt adapting laws to allow it.
Yes, exactly. Egypt, for instance, had its capital market law from '92, but they kept amending banking laws. Now they have, 6 active securitization companies? It shows it became an important part of the financial landscape globally.
So let's get into the mechanics. How does this actually happen? How do you turn a bunch of, say, car loans into a security someone can buy on a market?
Well, there are broadly 3 main ways it's done. The first one you could call debt replacement.
Okay, debt replacement. What's that involve?
It's kind of like swapping out the old loan agreement for a new one.
Yeah.
The original rights, the original obligations, they get replaced. But, and this is key, it usually needs everyone involved, the borrower, the lender, to agree. It's consensual.
Right, everyone has to be on board. What's the second way?
That's called assignment. Here, the actual ownership of the assets, maybe goods that were sold on credit or equipment being leased out, gets transferred.
Transferred from who to who?
From the original creditor, the one who made the loan or lease, to new creditors. These new creditors basically buy the assets or the rights to the payments from those assets. They pay the original creditor upfront.
Okay, so a straightforward sale of the asset or the income stream. And the third method?
This one's called partial participation. It often involves a specialized bank stepping in. This bank buys up receivables money owed to the original creditor and finances them.
Okay. What's different about this one?
The really interesting part here is risk. With partial participation, the original creditor, the one selling the debt, usually carries no responsibility if the original borrower defaults. The risk is completely passed on.
Ah, I see. So the original lender gets their money and washes their hands of the risk.
Pretty much. Now, for any of these methods to work well, the actual assets being bundled up, they need certain characteristics.
Like what makes a good candidate for securitization?
Well, first, they generally need to be homogeneous, meaning they should all be pretty similar, like a pool of 30-year fixed-rate mortgages, not a random mix of everything.
Okay, consistency. What else?
Volume. You need a lot of them to make the pooling and tranching worthwhile. And diversity is crucial geographically, socially, economically. You don't want all your loans tied to one town's factory, for example. Spreading it out reduces risk.
Makes sense. Spread the risk.
And, critically, credit quality. The loans need to meet certain standards. This is where rating agencies come in. They assess the pool and give it a rating.
Right, those AAA ratings we heard so much about later.
Exactly. And one more point, often the original bank or lender that issued the loans might still be the one managing them, collecting payments and so on. Even after they've sold the actual ownership, they act as the servicer.
That's a great overview of the how. But this is where things get really interesting, isn't it? Comparing this traditional model with Islamic finance. You said the differences are fundamental.
They really are. It goes to the very core of what's being traded and how risk is handled. Traditional or conventional securitization mainly deals with monetary debt.
Meaning debt from just lending money, like a cash loan.
Precisely. Debt that arises purely from a loan of money. Islamic securitization, sometimes called taslik, is broader, but also more constrained in key ways. It can involve some types of debt, but often focuses on commodity debt.
Commodity debt? What's that?
Debt that comes from the sale or lease of actual goods or services. Think of selling a car on installment or leasing equipment. The debt is tied directly to a real asset transaction, not just money creation.
Okay, so the underlying thing is different. How do Islamic authorities view that traditional securitization process we just described?
Well, the International Islamic Fiqh Academy looked at this specifically. Their ruling back in 2009 was pretty clear. Traditional securitization of monetary debt, especially when you turn it into bonds that pay interest, is not permissible. It's considered haram, forbidden.
Okay, so no turning straight loans into interest-bearing bonds. What's the Islamic alternative then?
The alternative involves issuing something called sukuk. Think of them as certificates. But instead of representing debt, they represent an undivided share, actual ownership in underlying assets.
Ownership of what kind of assets?
It could be existing assets like buildings or equipment or even future assets. It could be tangible things or the right to use something, usufruct or services, or sometimes a mix of these things along with some cash or permissible debts. The absolute key is that the whole structure must follow a Sharia-compliant contract.
So if I buy a sukuk, I actually own a piece of something real, not just a promise of repayment.
That's the fundamental difference, yes. With sukuk, you, the investor, have a direct ownership stake in real assets or the benefits from them. In traditional securitization, you typically own debt that's backed by assets, but you don't own the assets themselves.
And how does that affect the risk I take as an investor?
It changes it completely. Because sukuk investors are owners or partners, they share in the actual risk of the underlying assets. If the assets do well, they profit. If they do poorly, they share in the loss. Profit and loss sharing is central.
Whereas traditional bondholders usually expect a fixed return.
Generally, yes. Their debt is often guaranteed or has seniority, so their risk is typically lower. Focus more on the borrower's creditworthiness than the performance of the underlying asset itself.
What about trading them? Selling them on to someone else? That's huge in finance.
Tradability. This is another massive point of divergence. It gets a bit technical, but basically, Islamic sukuk that are based primarily on debt, like those arising from a murabaha contract,
Right.
that cost plus sale structure.
Right, you mentioned that.
Those are generally not tradable on the secondary market after the debt is created and owed. You can't freely sell that debt certificate to someone else.
Why not?
Because selling debt for anything other than its face value or selling debt for deferred payment runs into prohibitions related to riba, interest, and gharar, uncertainty.
But conventional bonds are traded all the time.
Exactly. They're designed for it. Now, other types of sukuk, like those based on partnership, musharaka, or leasing, ijara, which represent ownership in tangible assets or equity, can often be traded because you're trading a share of ownership, not just debt.
So the source of the return must be different, too.
Absolutely. Sukuk returns come from the actual economic activity of the underlying assets, rent from a property, profits from a business venture. Traditional bond returns come from the interest charged on the debt.
This really goes deep. What about the basic act of selling debt itself? Is that ever okay in Islam? Because conventional securitization is all about selling debt.
There are very specific rules. The Fiqh Academy, again, provided clarity. It is permissible to sell a debt to the debtor himself, maybe at a discount, for immediate cash payment.
Okay, selling it back to the person who owes it.
Yes. But it's forbidden to sell it to the debtor for a higher price to be paid later. That's debt rescheduling with interest, classic riba. And crucially, it's forbidden to sell debt to a third party, someone other than the debtor, if the payment is deferred. That's selling debt for debt, also forbidden.
And securitizing debt involves selling it to third-party investors.
Exactly. So securitizing debt to non-debtors for trading on secondary markets is generally impermissible in Islamic finance if it involves these prohibited elements, especially riba.
Given these rules, is Islamic securitization actually happening anywhere on a large scale?
Oh yes, Malaysia is the standout leader. They hold something like 70% of the global sukuk market, estimated around $300 billion. Interestingly, about 90% of their issues are reported to be murabaha sukuk, which raises questions about tradability based on what we just discussed, but the structures are complex.
So Malaysia's big. Anywhere else?
The UAE and Saudi Arabia are also major players, particularly in the Arab Gulf region. The market is definitely active and growing.
Okay, so we have these two very different approaches, traditional and Islamic. But are they trying to achieve similar things in the financial system? Do they share any goals?
Yes, despite the fundamental differences in how, they often share similar whys.
Yeah.
Both aim to provide liquidity. That's probably the biggest shared goal, turning those illiquid assets into cash for the originator to use.
Right, freeing up capital.
Exactly. Both also aim to reduce credit risk for the originator by spreading it out among many investors in different sectors.
Diversification, again.
Yep. And helping institutions reduce their debt burden, which can be important for meeting regulatory capital requirements, those capital adequacy ratios we mentioned.
Makes sense for banks.
Both also work to activate capital markets. They bring new funding sources online, create different kinds of financial products, and can stimulate trading activity.
So making markets deeper and more active.
Right. And potentially reducing financial intermediation, allowing borrowers to access market funding more directly, maybe bypassing traditional banks to some extent. Think mutual funds investing in these securities.
And broader economic effects.
Definitely. Securitization, in both forms potentially, can help enable development projects. It's a way for governments or public bodies, especially those running deficits, to raise funds for infrastructure or other initiatives.
A new funding channel for big projects.
It can also improve efficiency, speeding up the financial cycle, getting assets turned over faster by making them liquid so the capital can be used again, and potentially lowering borrowing costs by tapping into wider capital markets and maybe encouraging fixed-rate lending options.
So lots of potential upsides listed there. Liquidity, risk sharing, market development. But we know it didn't all go smoothly, especially with the traditional kind. What went wrong? The global financial crisis looms large here.
It certainly does. And it serves as a stark warning. Ignoring the potential downsides of traditional securitization, especially when it scaled up so massively, was incredibly dangerous. Studies point to basically 3 core factors that collided.
Okay, let's break those down. What was the first one?
Excessive lending. Plain and simple. Financial institutions were issuing way too many loans, and crucially, a lot of them were subprime mortgages.
Ah, subprime. Loans to people who couldn't really afford them.
Essentially, yes. High-risk borrowers, low-quality loans, often with complex terms like teaser rates. This massive concentration of risky lending was the first building block of the crisis.
And then securitization comes in and makes it worse.
That's the second factor. Traditional securitization and derivatives. Securitization allowed banks to package up these risky subprime loans and sell them off to investors, getting them off their own books.
So they didn't care as much about the quality?
That's the moral hazard issue we'll come back to. But then you had derivatives layered on top. Complex financial instruments whose value was derived from these underlying mortgage securities. You ended up with waves upon waves of products built on the same shaky foundation.
Driven by what? Just complexity for its own sake.
Driven largely by the chase for short-term profits. Greed, frankly. Each new layer offered fees and potential trading gains, with less and less connection to the real economy.
Okay, excessive risky lending, amplified by securitization and derivatives. What was the third piece?
Lack of oversight. Regulation was way behind the curve. Non-bank lenders like mortgage brokers, investment banks heavily involved in this stuff. Complex derivatives, they operated in regulatory shadows.
And the rating agencies, weren't they supposed to be the watchdogs?
That's perhaps the most shocking part. They were central to the problem. An incredible figure. Something like 80% of the securitized products backed by these subprime loans got top AAA ratings just before the crisis hit.
80%. AAA. That's unbelievable. How?
Conflicts of interest, flawed models, pressure from issuers, a whole host of reasons. But it created this completely false sense of security. Investors bought toxic assets thinking they were rock solid.
And you mentioned moral hazard earlier. How did securitization fuel that?
Because the originator, the bank making the loan, knew they could sell it off quickly. Their incentive to carefully check if the borrower could actually repay was drastically reduced. Why worry if the risk ends up on someone else's balance sheet?
So originate junk, sell it fast, collect fees, let someone else deal with the fallout.
That's the harsh summary, yes.
Yeah.
And then you had the domino effect. Because all these institutions were interconnected through buying and selling these complex securities and insuring them with derivatives like credit default swaps.
Yep.
When one part started to fail, like the subprime mortgage market, the losses cascaded through the entire system. One failure triggered others, like dominoes falling.
The scale of it all was just mind-boggling, wasn't it? Those derivative numbers.
Absolutely staggering. The global derivatives market hit nearly $600 trillion in 2007. That's trillion with a T. 10 times the world's GDP back then. It had grown sixfold in just 6 years. The estimated losses for financial institutions ran close to $1 trillion.
Just devastating. So turning back to the Islamic perspective, how do analyses from that viewpoint explain why this happened? What do they identify as the root causes?
From an Islamic economic standpoint, the analysis points to several fundamental issues inherent in the conventional system that are prohibited or discouraged in Islam.
Such as?
Firstly, the reliance on interest. Secondly, the widespread trading in debts. Thirdly, practices like debt rescheduling, where you just add more interest onto existing debt. Fourthly, the selling of debt to third parties, as we discussed.
Okay, the core debt-related issues. What else?
And fifthly, the whole system of financial derivatives. The argument here is that derivatives often separate risk from the underlying asset, turning risk itself into something you can buy and sell, almost like a commodity. This, it's argued, encourages speculation, volatility, and the creation of financial bubbles detached from real economic value.
It's interesting you mentioned interest, Reba. That prohibition isn't unique to Islam, is it, historically?
Not at all. It has deep roots. Christianity and Judaism historically prohibited usury as well. And even ancient Greek philosophers like Plato and Aristotle condemned it.
Aristotle, what did he say?
He famously compared money lending for interest to a barren hen. Money itself doesn't naturally reproduce, so charging for its use was seen as unnatural and unjust. It wasn't tied to actual productive activity or trade.
Even in modern times, there have been questions about interest, right? Like Japan.
Right. Faced with deep recession, Japan's central bank actually pushed interest rates down to zero between 2001 and 2006, trying to stimulate the economy. It shows that questioning the role of interest isn't purely historical or religious.
And that debate around derivatives, useful risk tools versus speculation.
Exactly. Proponents see them as vital for hedging, allowing businesses to manage price risks. But opponents, especially in Islamic finance, often view them as primarily tools for speculation, even gambling.
Gambling how?
Well, they argue many derivatives don't add real economic value. They just facilitate bets on price movements, transferring wealth rather than creating it. A major Islamic finance symposium, Al-Baraka, back in 1999, issued a fatwa stating many modern options and futures contracts are generally impermissible.
Why specifically?
Often because they involve deferring both sides of the exchange or effectively selling something you don't actually own yet, which goes against core Islamic principles of trade needing clear ownership and tangible exchange.
So given these criticisms of conventional practices, how does the Islamic finance approach offer potential solutions or safeguards against these kinds of crises?
Well, the prohibitions themselves act as built-in safeguards. Forbidding the easy trading of debt, especially monetary debt, means lenders have more skin in the game. They can't just originate loans and immediately sell off all the risk.
So they have to be more careful about who they lend to.
Yeah, exactly. It encourages more prudent credit assessment. And critically, by restricting debt trading and purely speculative derivatives, it helps prevent the financial system from ballooning massively beyond the size of the real economy, the economy of actual goods and services. It inherently ties finance more closely to real economic activity.
Keeping finance grounded in a way.
That's a good way to think about it. It aims to prevent the buildup of those huge, unstable towers of debt and speculation based on very little real value underneath.
So let's try and pull this all together for you, our listener. We've journeyed through securitization, this tool designed for liquidity. We've seen it comes in two very different flavors, traditional and Islamic.
And those differences run deep. right down to the permissibility of trading debt versus the focus on owning real assets and the rejection of interest, REBA.
Right. And we've starkly seen the consequences when traditional securitization, combined with derivatives and weak oversight, went into overdrive the global financial crisis. A painful lesson about unchecked innovation.
It highlights the potential dangers when finance becomes detached from ethical principles, principles shared across faiths historically concerning interest and speculation.
So here's a final thought to leave you with. Given that clear link we saw between certain financial practices and massive instability, what if future financial systems were built differently?
What if they had at their foundation a stronger commitment to real asset backing and a conscious move away from pure speculation, drawing perhaps on some principles from Islamic economics?
What questions does that raise for you about how we regulate markets today? How do we ensure transparency? How do we genuinely manage risk globally so history doesn't just keep repeating itself?
Yeah, something definitely worth thinking about as you navigate the complexities of the modern financial world.